Hey traders, Nick here on Sunday night doing the strategy video for the week coming. So we've made, first of all, we were looking for stabilization for 3 weeks and we got that. We even have a little bit of a progress. It depends on which index you're looking at. Here on the upper left hand, we have the S&P, and then we have the NASDAQ right there. On the lower left, we have the Dow, and then lower right, we have the IWM, which are the small caps. That's a basket of 2,000 stocks. So it represents the market more so than, say, the NASDAQ, which depends heavily on maybe 7 stocks. The perspective from each of those is almost completely different. So what we have is a hot mess. So I want you to, if I were you, what I'm doing is I'm throwing all the fundamentals out the window. Like when somebody says, oh, we have a recession, therefore in a recession somebody does that. You ditch tech for this. I think they're all full of it. There is nothing usual, so you cannot apply anything you learned from the past. It's a hot mess, and let me explain. The NASDAQ, which is the weakest now, led by Apple down and Tesla and Google and Amazon, they can't find footing, right? They're being sold heavily, are still trying to hold the November base of the pandemic year, 2020. The S&P did that already a while back, it jumped and came back, and now it's above it. They're dealing with later period of time. So this is the first visit, kind of, in the NASDAQ. Like the relativity for that period is not the same in both of these, and it's a completely different scenario from the Dow. The Dow closing level on Friday is within 7.4% of the all-time closing high. The week closed 7.4-ish% off the all-time closing high, not the full value high. That's pretty incredible. And then you have a basket of 2,000 stock that's trying to base. It's consolidating for a long time. Same with the SPY. Not so for the NASDAQ. It's more like a descending channel trying to consolidate. This one is trying to break out. You see the mess? This one is ready to go. This one is trying to consolidate inside a massive, very wide range. This one is a much tighter range. And this one is a descending wedge looking to bounce or break down. So you have to be careful this week. You have to be very careful. We have 2 potential emotional drivers. I believe Powell speaks on Tuesday. Please double check. My schedule is sometimes wrong, and it says that he speaks before the market opens, which probably is when he releases the statement. If that's the case, then Monday may end up badly. Like it might start well because right now the futures are open up a little bit after a really strong Friday. So maybe we close weak, like in a weak fashion. Maybe traders will be a little bit nervous about how Tuesday morning is going to go. And if he says nothing in his speech, then maybe we have an up Tuesday and then a down Wednesday into the CPI report in anticipation of the reaction of the CPI report. So it's going to be messy. What I did is I had longs. Last time we had a dip when markets were falling, my strategy was to catch the dip, and I took longs and I shared them. The last ones were IWM longs, and I closed them on this length, on the strength. So if somebody left runners, in other words, they left a few running longs, then that's fine. But I'm not looking to chase from here. I think the onus is on the bulls to maintain another week, and that's going to be slightly difficult. So let's see. This is the S&P on a weekly basis. And if you want specifics to that comment, I want to see us take out these levels before we lose these levels. So whatever bottoms we put recently and more recently here, we want to take these out first. And if we do, then we can get to here. It doesn't matter the values exactly. Just remember, wherever we failed most recently are problem areas. Wherever we bounced hard, we must hold. And we have several levels of those. Some recently in December, some in November, and most definitely the October lows cannot be lost. If we lose the October lows, it's a complete disaster, which means Apple is almost 2 digits in that scenario. Okay, so these are like the top level explanations of the levels. I'll have more detailed information in the write-ups before the market opens. Okay, so a little bit more granularity here. I'm going to give you the daily chart of the S&P SPY. Everybody's familiar. If you give me this chart and you don't tell me what it is or what's going on in the world, I would tell you the bulls are trying to break out. They have made quite a bit of progress, but they should face some selling in the short term before they make more progress. So yes, they're trying to take over the reins, but this is just a reaction. They were giving back about half the rally. So let's get a little bit more granularity. Whoops, I'm going to go to the 30-minute, not 30 seconds. And here, technically, if we don't take out the Friday highs immediately, we could fade down to 385. That number has been pretty important. I would stretch it to 383. So if we rallied from here to here, and we give back half, so 384, 383.8, 383.5, it's normal process. So I wouldn't freak out and start buying puts. So maybe they freak out on Monday in anticipation of Powell and they come down to here. My instinct would be to try to get long. Now, if we lose this, that's a different story. Okay, so my instinct is to get long on dips just like we did before. I just closed the longs that I bought on dips. Rinse and repeat. Longer term, I'm looking for longs into stocks I like that are approaching or have hit support. If not, then I'll try to sell credit put spreads against some levels that are proven pretty hard to lose, and maybe even some iron condors to waste some time waiting. Here's another look at why I think there should be sellers. This is the last time we were here, not too long ago, a few days ago. This was January 3rd, and look at how it ended up. Here we are. So I'm not saying it's going to end up all the way back here. I hope it doesn't. And halfway would be great, even down to 264, because I want them to come back and try to take this out after 3 attempts. So 1 failed, 2 failed, and get the third one. We will get eventually to 275. Now, 275, 276 is important for a longer-term purpose. So step 1, let's dip a little bit, find footing, come back and take this out. So these are just specifics. But the concept is, if they freak out on Powell because he's not going to say anything new, or on the CPI because it's not going to tell us anything new, we still have inflation. It's less than before, so we peaked inflation. And it's not going to tell us inflation's gone. Powell's not paying attention. So those are not changes. They are freak out moments, emotional reactions. They'll try to make money off of that emotional reaction. It's one thing to try to guess what they're going to do, but it's smarter, in my opinion, to wait for them to do what they want to do and see if you can make money off of it for a trade. Otherwise, I just invest by specific stocks for the longer term swings, 3 weeks to 3 months. Important stocks to pay attention to would be Apple. It's the leader. I need Apple back above 134. If it goes above 134, 135, dip a little bit, come back and take it out to get to 135. Then it may erase the bearish scenario that Tesla went through, that AMD went through, that Nvidia went through, that the crypto went through. By the way, speaking of crypto, I want to throw 2 curveballs to the perma bears here. Nobody is talking about the reopening of China's impact on the world. So China in the past was the growth engine of the world because of how fast they were growing. Well, they stopped growing because they've been closed for 3 years. In spite of all the deaths, how are the Chinese businesses going to react to the reopening? How fast are they going to have an explosion of business? I don't know. And how will that ripple through the world? So that's upside potential that not many people are talking about. That's one. The second one is the fact that crypto, I have a lot of junk crypto coins that are catching fire. You know, things that have been dead, and suddenly now the risk appetite to the riskiest of the risk. Crypto is the riskiest asset class, and then the riskiest coins in there are catching a bid. So scared money, there is no scared money. There is an appetite to invest even in crap. You know, that's the logic. So once the 30-day wash sale rule expires from the tax selling that happened last year, I bet you there'll be bids in stock. So waste some time. I would want to stay biased long to catch the wave out without new headlines. If we get new headlines, again, not Powell, not the CPI, that's old headlines, something new, something we haven't had before in the headlines, then we might have a scenario for a lower washout.